Retired millionaires hardly ever let their IRA pay the tax on their conversion. They just do it from a completely different pocket. And that one move could be worth up to $70,000 in today's example. And it's all legal. So you've got $1 million plus in retirement, pre-tax retirement accounts. This tax planning conversation can move the needle more than anything else that we talk about on this channel. But if we do it incorrectly, it could really impact your most valuable account, that Roth IRA, or it could cause you to pay way more in healthcare costs than you need to. My name's Kendall Stahl, and I'm a financial advisor here at 210 Financial. And one of the things that we do every day is tax planning. So if you need help with it, grab some time on our link below and we're happy to do that. What I want to talk you through is the best way to pay taxes on a Roth conversion in this video. And so when we think about it, what the default is for when most people do a Roth conversion at custodians, it's simply they withhold the tax from their Roth conversion out of that conversion. So in the example, if we've got a $100,000 Roth conversion, we convert it to an IRA. They take, say they're in the 22% bracket, $22,000 out of there, and now only $78,000 goes to the Roth IRA. The other 22 goes to the IRS. And it still can be the right move to do a Roth conversion and do it that way. But a better way to do a Roth conversion is if you have cash in your pocket that you're able to write those checks to the IRS, it's going to mean substantially more over the rest of your lifetime. The other thing that we need to think about too is that if you have brokerage accounts out there, so taxable accounts, your brokerage account, individual account, joint account, we all have different slang lingo for that. And it's simply your non-retirement accounts. Maybe it makes sense to actually pay the taxes out of that account instead of holding it from your Roth conversion. So let's say you don't have enough cash in the bank, or you've got reasons to use that cash for something else. Maybe it's going to make sense to go to your taxable account and start taking some money out of there to pay the taxes. But then you're like, whoa, whoa, whoa. When I do that, now I've got to pay capital gains tax. And you're like, why do I want to do that? Well, if we think about it, if you're in the 22% tax bracket or even the 24% tax bracket, it's going to cost you roughly 22 or 24% to convert those dollars from IRA to Roth. All right. And so if we withhold that money out of there, in my example earlier, 100,000, we withhold 22, 78 goes into the Roth IRA. That's $22,000 that's no longer growing. It went to the IRS. But if instead we take $100,000 out of the IRA, put $100,000 in the Roth IRA, and then go to your brokerage account or your taxable account, however you want to say that, and take the money out of there to pay the taxes, that money is taxed at capital gains tax rates, which are in most cases lower. If you're married, filing jointly, you can go up to 98, 99,000 roughly of taxable income before you even have to pay capital gains tax. So potentially you get money out of that brokerage account without paying capital gains tax. Or if you're in the next capital gains bracket, it's the 15% bracket. Well, 15% is a lot less than 22% when we withhold that money from the IRA Roth conversion. And so using that money in the brokerage account to pay the taxes as opposed to the money in the IRA to pay the taxes can be beneficial to you in the long run. And the thing is that like this tax planning thing is pretty complicated, right? And so we've put together a toolkit for you, and you can grab that down there in the description below. And it's going to talk about these things when it comes to Roth conversions and capital gains tax and all of that. So go ahead and grab that if it makes sense and you're trying to figure out taxes. But the other thing I want to bring to light that I don't think a lot of people talk about is simply the fact that your capital gains tax rates and your normal income taxes are competing for the same space inside of your tax bracket. So what do I mean by that? If we do a $100,000 Roth conversion, right, that's taxed as normal income. It's filling up your tax brackets on top of whatever other income you have. All right. And so if you were in a 0% capital gains tax rate, but you did a Roth conversion, it may push you into a 15% capital gains tax rate. And there's strategy behind that, right? And so they're competing, those capital gains and those normal incomes. So there's two different account types, the IRA and the taxable or the brokerage account, are competing for the same space inside of your tax bracket. And so retired millionaires know these things, and they're being strategic behind what type of dollars they withdraw when. So maybe there are years where we take money out of our brokerage account to live on, as opposed to taking money out of IRAs to live on. Maybe there are years where we use the money inside of the brokerage account to pay a Roth conversion, as opposed to cash in the bank. Maybe there are years where we use money from the conversion to pay the taxes instead of from the brokerage account. What I'm trying to say is we need to understand that that tax bracket is always competing for what types of dollars are being used, and we need to have some sort of a strategy behind how we're filling that tax bracket up. Because there are years where we really need to sell some gains off in our brokerage account because it's done so well and we feel the need to reinvest or reallocate. There are also years where we're thinking about required minimum distributions coming along and us having to get some Roth conversions done so those RMDs don't really slap us in the face one day. And so when we think about tax planning and we think about just converting dollars from Roth to an IRA, and we use money out of our bank to do it, I was gonna show you that $70,000 difference. This graph is showing a $100,000 conversion and what it looks like at a 6% growth rate over the next 20 years. All right, so if we take $100,000 out of an IRA and we put it into a Roth versus if we take and pay the taxes out of our pocket or out of the bank, versus if we take $100,000 out of an IRA and send $22,000 to the IRS and put $78,000 in the Roth IRA, and we let those dollars grow at 6% over the next 20 years, what does that look like? Well, it looks like one bucket has $320,000 in it. The other bucket has $250,000 in it. That's a $70,000 difference by just understanding the best way to pay taxes on Roth conversions. All right, we've talked about Roth conversions today, and we've talked about strategies behind filling up your tax bracket. I made a video on the perfect withdrawal strategy to pay less in taxes, and it really couples up with this video and talks about not just Roth conversions, but taking dollars out to live on and the best way to do that in order to not pay more in taxes than you need. So check that video out here.